Welcome to the Deep Dive. Today, we are cracking open the International Monetary Fund's October 2025 Global Financial Stability Report. And the title itself, it really sets the stage, Shifting Ground Beneath the Calm.
It really does. It's an essential read, I think, for anyone trying to navigate today's markets. Our mission today is pretty clear. We need to look past that surface calm, the low volatility, the tight spreads, and really drill down into the structural vulnerabilities, the ones that are, well, actively accumulating just beneath the surface.
Yeah, and the report argues pretty compellingly that while things look stable, the actual downside risks to global financial stability are, still acutely elevated. Their growth at risk framework really highlights this.
It's a striking paradox, isn't it? You've got all this economic and geopolitical uncertainty. We had those disruptive tariff announcements back in April 2025.
Right.
And yet markets have largely bounced back. There's plenty of global funding liquidity washing around.
But the IMF sees these deep cracks forming, and they're focusing on three critical areas, which, importantly, are highly interconnected. We need to talk about, first, stretched asset valuations, second, those rising sovereign debt pressures, and third, the rapidly expanding risks from non-bank financial intermediaries, the NBFI.
Exactly. And it's the interconnectedness that's key here. It's a structural issue. It's not just that these risks exist in isolation, but that pressures, say, in high-flying tech stocks or in core government bond markets or deep within the shadow banking system, they're actually converging.
Converging, meaning they amplify each other.
Precisely. So when the next shock inevitably hits, the resulting instability could be amplified through channels that, frankly, haven't been severely tested in this configuration before.
Okay, so quite a setup. Let's unpack this then. Where should we start? Maybe where the calm seems most deceptive.
Right.
Those asset valuations, particularly in equity markets.
Yeah, let's start there. If you look at the recent data, financial conditions globally, they've eased quite significantly since the April GFSR came out. These financial conditions indices, they basically measure the cost and availability of funding. They've moved pretty swiftly back into what we'd call accommodative or, easy territory, especially in places like the U.S.
And that easing itself feels like the first red flag, doesn't it? Because it's happening despite all these headwinds we mentioned, economic uncertainty, geopolitical risk. Those are still stubbornly high.
Absolutely.
So the key takeaway here seems to be that markets are, well, they seem almost complacent, like they've collectively decided to downplay the potential long-term structural effects of, say, tariffs or geopolitical tensions on growth and inflation.
It's as if they're treating these as temporary bumps in the road, something that, monetary policy or just corporate resilience can smooth over quickly. And you can see that complacency reflected in our internal analysis. If you look at figure 1.5 in the report, which tracks that financial conditions index, it's the rebound in corporate valuations and that sharp drop in market volatility. Those are the main things driving the index back into easy territory. Historically speaking, it's looking quite comfortable, perhaps too comfortable.
And historically, that level of comfort or complacency is problematic.
Highly problematic. Because it essentially means risk premiums are too low. Investors aren't demanding enough compensation for the risks they're taking. And that creates an environment where, well, abrupt, sharp corrections become much more likely when some adverse shock inevitably comes along.
Right. And we're seeing that risk showing up most acutely in equity markets, you said, particularly the U.S.
Yes, absolutely. The rebound there has pushed global equity prices way beyond expected future earnings. We're not just talking marginal overvaluation. If you look at the S&P 500's 12-month forward price-to-earnings ratio, the PE ratio, it's climbed back to around the 96th percentile since 1990. That's an extreme level.
96th percentile. Wow. So highly stretched.
Very stretched. Our valuation models, when they look at the underlying fundamentals, things like expected interest rates, earnings growth, risk premium, they estimate the current overvaluation is about 10 percentage points above what the model suggests is fair value.
Okay, 10 points above fair value. How does that compare historically, like the dot-com bubble?
Well, that's a good question. It's actually still below the absolute peak we saw back then, during the dot-com bubble. But the risk today is acute for a different reason. It's not just high valuation, it's concentration.
Ah, right, the concentration risk. That really seems to be the headline finding in the equity section, doesn't it? It's at a historic high in the S&P 500.
Yeah.
You're talking about the Magnificent Seven, the M7 stocks, plus other AI-related names.
That's right. Those stocks alone now account for a staggering 33% of the entire index's weight.
33%. Just 7 or so stocks.
Well, the M7 Plus related AI stocks, yes. And just to put that into context for you, that level of concentration, it's almost identical to the weight the entire technology, media, and telecom sector, the TMT sector, held right at the peak of the dot-com bubble back in 2000.
Okay, that comparison really lands. So it's not just high valuations, it's high valuations resting on this very, very narrow base of stocks.
Exactly, which means the broader index is incredibly vulnerable. If those few mega-cap stocks fail to deliver the, frankly, near-perfection level returns needed to justify these lofty valuations,
The whole market could take a hit.
a significant hit. The immediate danger isn't necessarily that the entire market suddenly collapses based on fundamentals across the board,
Right.
but that a correction in just those 7 or maybe 10 highly weighted stocks could trigger a very sharp sudden repricing across the whole index, especially amplified by all the passive investing that just tracks these indices blindly.
Right, the index funds have no choice but to sell if the cap weights fall.
Precisely. And analysts' expectations actually reinforce how precarious this is. If you look at the divergence in expected profits, it's quite telling. Analysts have significantly revised down their expectations for profit margins for the majority of S&P 500 firms. They're factoring in higher labor costs, supply chain issues, tariffs.
Okay, that makes sense.
And this is critical profit margin expectations for the M7 group. They've been revised up.
So the market thinks these giants are somehow immune to all those pressures. The tariffs on chips, the cost of AI infrastructure.
That certainly seems to be the perception baked into the prices, that these tech giants can somehow sidestep the global headwinds and rising input costs affecting everyone else. And that perception, that assumption of immunity, is exactly where the concentrated downside risk lies. If that assumption proves wrong, and our analysis suggests rising costs will inevitably compress even M7 margins eventually,
Then the resulting correction could be severe.
very severe. A miss on earnings or guidance from just 1 or 2 of those key companies could potentially trigger massive deleveraging, forced selling feedback loops, given how tightly the market is clustered around these few names right now.
Okay, so that paints a picture of, let's say, fragility at the very top layer, the equity market layer of the financial system. Now let's talk about the foundation. Moving on to our next major theme, those hidden pressures building up in core sovereign bond markets, U.S. treasuries, German bunds, the assets that are supposed to be the bedrock. And the report suggests they're starting to look a bit shaky because of structural fiscal issues, ##2, rising sovereign debt, and shaky bond markets.
That's the critical pivot, exactly. The stability we normally take for granted in those instruments, like treasuries, it's facing fundamental pressure from rising fiscal risks.
And you can see that in long-term bond yields, right? They're clearly under pressure.
Definitely. And the pressure comes mainly from rising fiscal deficits across major advanced economies, particularly those countries that already have high debt levels and, crucially, lack credible plans to stabilize that debt over the medium term.
So the key takeaway here is this isn't just a cyclical blip, it's more structural.
Yes, that's the argument. Higher long-term yields, or more specifically, the term premium component of those yields, could become a defining, persistent feature of global financial markets in the coming years. Remember, the term premium is basically the extra compensation investors demand for the risk of holding a longer-term bond versus rolling over short-term ones. It reflects uncertainty about inflation, interest rates, and importantly, fiscal risk.
Okay.
And if you look at Figure 1.9, Panel 2 in the report, the data is pretty stark. You see a strong co-movement between long-term bond yields and the projected average budget balances over the next 5 years. Markets are essentially demanding higher compensation for lending to governments whose fiscal paths look uncertain.
And central bank policy is adding to this pressure too, right? Through quantitative tightening or QT.
Yes, that's another layer. As major central banks continue QT, they're shrinking their balance sheets. This means they're selling bonds or letting them mature without reinvesting. And that increases the supply of what we call free-floating bonds, bonds that have to be absorbed by price-sensitive private investors rather than just sitting on the central bank's balance sheet.
And these private investors are more sensitive to price and risk than the central bank was.
Exactly. So this absorption pressure is not insignificant. It puts further upward pressure on term premiums, helping to keep yields elevated and potentially leading to a steeper yield curve. It's really a structural shift in who holds the world's safest debt, and that makes price discovery potentially more volatile.
We're also apparently seeing an erosion of the safe asset status of these core government bonds. The report uses a technical measure for this, convenience yields. Can you unpack that for us? What is a convenience yield, and why does its erosion matter?
Sure. So core government bonds like treasuries are prized for two main reasons. One, they're highly liquid and expected to hold their value or even increase during times of stress. Two, they serve as critical collateral in short-term funding markets, like the repo market.
Okay.
The convenience yield is essentially the non-monetary benefit investors get from holding these assets, the value derived purely from their safety and liquidity. It's like a premium investors are willing to pay by accepting a slightly lower yield just to hold the best, most liquid collateral.
Got it. And that premium is shrinking.
That's what the data suggests. The supply of these safe assets has ballooned because of all the fiscal expansion in G4 economies.
Hmm.
At the same time, demand for long-duration safe assets has actually declined somewhat, partly due to central banks diversifying reserves, for instance.
Hmm.
And critically, the report looks at cross-border convenience yields, CCYs, for U.S. Treasuries compared to other G4 government bonds. And it finds a secular erosion over the past decade.
Secular meaning long-term, not just a short-term dip.
Exactly. This isn't just a temporary blip. It reflects a longer-term structural shift. And it aligns with market commentary suggesting global investors might be getting fundamentally more cautious about holding U.S. assets, perhaps due to political uncertainty or those long-term debt trajectory concerns. It suggests the unique preeminent status of treasuries as the global safe asset might be structurally diminishing, at least at the margin.
Okay, so what does this erosion of convenience yields actually mean for the financial system beyond just bond prices? This is where funding market strains start to bite, right?
Precisely. This erosion is a signal of potential tangible strains in funding markets. Think about the repo market, where institutions borrow short-term using treasuries as collateral. If the perceived safety, that convenience of the collateral erodes, lenders could start demanding higher haircuts, meaning they'll lend less against the same amount of collateral.
Which pushes up funding costs.
Right. It pushes up funding costs for institutions that rely heavily on these bonds for their daily liquidity needs. And this can trigger a dangerous cascade. Institutions might suddenly prefer different types of collateral, shifting demand rapidly and amplifying stress across the entire short-term funding system.
This inherent vulnerability, this potential fragility in the core bond market structure, it leads us straight to a pretty terrifying prospect mentioned in the report,
Right.
the risk of forced liquidations within bond mutual funds.
Yes. The report argues that sovereign bond markets are on shakier footing now, and liquidity risks in bond mutual funds is a critical systemic vulnerability.
And they've tried to quantify this risk.
They have, using a rigorous scenario analysis. They call it a waterfall approach. Essentially, they estimate the forced sales of treasuries and other bonds that funds would have to make if they face large investor outflows after exhausting their most liquid assets first.
Okay, so let's walk through the scenarios. What does the moderate scenario show?
Under a moderate stress scenario, they model this by combining the kind of outflow seen back in April 2025 with about a 60 basis point rise in interest rates. The estimated forced sales come out at around $66 billion.
$66 billion.
Yeah. And importantly, over half of that, more than $33 billion, would be forced sales of U.S. Treasury securities. Now, $66 billion might sound manageable in the context of the huge multi-trillion-dollar Treasury market.
That's what I was thinking. Is $66 billion really systemic?
Well, that's the crucial point. It's not just the absolute volume, it's the speed and the one-sided nature of those sales hitting the market all at once. The capacity of market intermediaries, the primary dealers who are supposed to absorb these flows and match buyers with sellers, is constrained, especially since post-2008 regulations.
Right, their balance sheets aren't as flexible.
Exactly. So when you get these rapid, forced, one-sided sales, dealers can quickly hit their regulatory capital limits and just step back. They stop making markets, and liquidity evaporates.
Okay. And that brings us to this severely adverse scenario. This is where the real systemic risk lies, potentially overwhelming that limited dealer capacity.
That's the concern. Under a severely adverse scenario, which models a really extreme outflow event, like a 99th percentile historical outflow, combined with a sharp 100 basis point rate rise, the forced treasury sales could potentially exceed current dealer inventories several times over.
Wow.
We'd be talking about sales volumes that could simply overwhelm the market's intermediation capacity, that could cause genuinely disorderly conditions, potentially looking frighteningly similar to what we saw in the March 2020 Dash for Cash episode, where liquidity in the Treasury market essentially vanished overnight.
Okay, so just to recap where we are. We've got stretched equity valuations resting on a narrow concentration of stocks. We've got a shaking foundation beneath the core bond market, driven by fiscal deficits and structural liquidity fragilities. Now, let's bring in the third major piece of the puzzle. That rapidly expanding, deeply interconnected world of non-bank financial intermediaries, the NBFIs. Because this is where, as you said earlier, the problems in the first two areas get dangerously amplified.
Exactly. This amplification factor is why the NBFI sector warrants so much attention now. I mean, the sheer growth has been phenomenal. It significantly outpaced traditional banks. Back in 2023, NBFI's share of total global financial assets hit a major milestone, 49.1%. It's about $239 trillion. They are now almost half of the entire global financial system.
Almost half. It's staggering. It's not just the size, right? It's how densely interconnected they've become with the traditional banking system.
Absolutely. The report highlights that banks' exposure to NBFIs is enormous. We're talking about $4.5 trillion just in Europe and the United States. And get this. A huge chunk of that exposure isn't even loans already made. It's undrawn credit commitments, lines of credit that NBFIs can draw down instantly if they get into trouble.
Which puts the liquidity risks squarely back onto the banks in a crisis.
Precisely. And that concentrated exposure creates a major potential channel for systemic risk to spread. The report finds that in the U.S., banks representing almost half of the sample assets have NBFI exposures that actually exceed their Tier 1 capital.
Exceed Tier 1 capital. So a major problem in their NBFI book could theoretically wipe out their core capital buffer.
That's the implication. And this concentration risk is particularly acute among the large regional banks and also among smaller institutions, those with assets under $100 billion. And what's more, these banks, the ones with high NBFI exposure, also tend to rely more heavily on non-core funding sources, like wholesale funding, rather than stable retail deposits. So you have this dangerous combination: high concentrated exposure to a potentially volatile sector, plus a more fragile funding structure themselves. It makes them significantly more vulnerable than their peers with low NBFI exposure.
So to really grasp the potential for contagion, the report actually stress-tested this bank NBFI link, didn't it? They looked at what happens to banks if NBFI credit quality deteriorates and those NBFIs suddenly draw down 100% of those undrawn credit lines you mentioned.
Yes, exactly. And that stress scenario showed some pretty dramatic potential impacts on bank solvency. If the average risk weight applied to NBFI exposures rose from, say, 20% to 50%, reflecting a severe downturn, and those credit lines were fully drawn down, we could see Common Equity Tier 1, CET1 ratios, that core capital measure, decline by more than 100 basis points in about 10% of U.S. banks, and worryingly, about 30% of European banks.
100 basis points is a huge capital hit. That would force banks to either raise substantial new capital or drastically shrink their lending.
Absolutely. And then, when you embed that specific NBFI shock into the IMF's broader global stress test, GST, adverse scenario, which is already a very tough scenario, assuming stagflation, a big tariff increase, a major surge in term premiums of 300, 500 basis points.
Right, a really nasty mix.
The results become quite alarming. Adding the NBFI shock significantly increases the share of globally weak banks, defined as those whose CET1 ratio falls below the key 7% threshold. It pushes that share up to 25% of global bank assets. So the non-bank connection acts as a catalyst, pushing a significant chunk of the global banking system towards severe vulnerability under stress.
Okay, let's zoom in on one specific, very large part of the NBFI universe that's seen explosive growth. Private credit. The report mentions the direct lending industry has shown some resilience, but maybe that resilience is a bit deceptive.
Well, it has appeared stable, but perhaps through somewhat fragile means. The industry has managed to maintain stability partly through flexibility in its loan terms, specifically the widespread use of payment in kind, or PIK, features, and also lots of amendments and restructurings.
PIK. That's where the borrower pays interest by issuing more debt instead of cash, right?
Exactly. So it helps stabilize the reported average interest coverage ratio, ICR, because technically the borrower isn't defaulting on the cash interest payment, but they're just compounding their debt burden.
Sounds a bit like kicking the can down the road. If you're using debt to pay interest on existing debt, the underlying liquidity problem is still there, just hidden.
Precisely. And despite these adjustments, the report finds that liquidity remains significantly strained among the more vulnerable borrowers, especially those who took on debt before the big rate hike started in 2022, what they call the older vintages. Defaults are demonstrably more common among these older cohorts who were financed during the era of much cheaper money.
And what seems genuinely new, and may be concerning, is the push to bring retail investors into this traditionally institutional market.
Yes, this introduces a whole new layer of potential risk, particularly liquidity risk and, crucially, procyclicality. Private credit managers are actively, even aggressively, developing products aimed at retail investors, things like perpetual non-traded business development companies, or BDCs.
So what's the risk there?
Bringing retail money into fundamentally illiquid assets like private loans introduces the classic risk of investor panic and runs during market stress. These retail-focused funds tend to track broad market sentiment very closely, so their inflows and outflows become highly procyclical. Money rushes in when markets are hot, and it rushes out even faster when markets turn sour. This can amplify credit downturns, forcing the funds to sell assets into already weak markets.
Okay, another amplifier. Now, the NBFI segment also includes the rapidly growing world of stablecoins, and the report flags their increasing and quite specific influence on U.S. Treasury markets.
That's right. Stablecoins, as you know, are typically designed to maintain a stable value, usually pegged to a currency like the US dollar. And they're generally backed by reserves of high-quality liquid assets. Predominantly, this means short-term government bonds, mostly US Treasury bills.
And their growth has been pretty explosive.
Exponential, really, reaching hundreds of billions in market capitalization. And as a result, stablecoin issuers have become some of the largest buyers of short-term government debt. This has actually had a measurable impact already. It's put downward pressure on U.S. Treasury bill yields, the very shortest-term government debt.
Interesting. So if they continue to grow at this pace, what are the broader financial stability implications?
Well, there are a couple of key concerns. First, if stablecoins keep growing and start to significantly displace traditional bank deposits as a place people hold cash, demand could shift disproportionately towards these very short-dated treasury bills where reserves are held. This could potentially lead to a steeper yield curve overall. It also raises concerns about credit disintermediation. If banks lose deposits to stablecoins, they might have less funding capacity for traditional lending activities.
Okay, that's the structural shift concern. What's the second implication, the more immediate risk?
The second, and perhaps more critical risk, is the potential for a run on a stablecoin. If confidence were lost in a major stablecoin issuer, maybe due to concerns about its reserves or operations, you could see a run similar to a bank run. And this would trigger massive forced sales of its reserve assets, mostly those short-term T-bills. Given the sheer scale these issuers have reached and their concentration in short-term debt, such forced sales could potentially disrupt the functioning of the crucial short-term funding markets. The very same markets that, as we discussed, might already be strained by things like the declining convenience yield of treasuries.
Okay, so we've really established this complex web of vulnerability now. Stretched equity markets on top, a structurally fragile sovereign bond foundation below, and this massive interconnected non-bank sector acting as an amplifier, transmitting stress through concentrated exposures and liquidity mismatches. The convergence of these risks seems to be the IMF's core warning here.
It is, and that naturally leads us from diagnosis to prescription, which brings us to the policy imperatives outlined in the report. The crucial steps policymakers really need to consider now to navigate this shifting ground.
Right, let's start with the basics. Macroeconomic stability and monetary policy. Given the potential inflationary impact of tariffs and ongoing supply shocks, central banks can't really afford to ease up too quickly, can they?
No, they need to remain highly attentive to those inflation risks, especially in economies where inflation is still stubbornly above target and where tariffs could act as a persistent supply shock, pushing up import costs. This really demands extreme caution with any potential monetary easing cycle.
Because if they move too quickly towards easing, it might signal to markets that they're willing to look past inflation risks, which could just fuel more pressure on those already stretched asset valuations we talked about.
Exactly. It could reinforce that cycle of complacency, particularly in risk assets like those high-flying M7 stocks. So a prudent, cautious approach to any easing is vital, not just to keep inflation expectations anchored, but also to help temper some of those valuation pressures. And of course, underpinning all of this is the need for central bank operational independence. That's absolutely crucial for maintaining credibility in this kind of uncertain environment.
Okay. Then there's the structural issue of sovereign debt. This demands urgent fiscal attention, even though it's often politically very difficult to deliver.
It is difficult but critical. Urgent fiscal adjustments are needed to get debt trajectories onto a sustainable path. This is fundamental to protecting the resilience of sovereign bond markets. As we saw, high debt levels and, frankly, the political perception that adjustments will keep being delayed directly pushes up borrowing costs and term premiums. Fiscal discipline is really the core requirement here to restore market confidence and maybe reverse some of that erosion in the safe asset status of core government bonds.
But fiscal discipline alone isn't enough, is it? The report also calls for structural improvements in the bond market itself to handle those potential liquidity stresses.
Absolutely. Discipline addresses the supply side, but we also need market structure improvements. The report advocates for tangible things like expanding central clearing for both cash bond and repo transactions. That would reduce counterparty risk and increase transparency. And moreover, ensuring that central banks have robust, well-designed standing liquidity facilities ready to backstop these core government bond markets is crucial, especially the Treasury market. These facilities act as an institutional safety valve, hopefully preventing a repeat of that March 2020 dash for cash scenario, which, as those forced sale estimates show, remains a credible threat.
Right. And our final policy focus area, tackling the risks in that massive intertwined banking and non-bank financial sector.
Yeah, this requires a multi-pronged approach. First, for NBFIs themselves, regulators simply must improve oversight. This means better data collection. We still have significant data gaps, better analysis, and much better coordination, especially across borders. NBFIs operate globally. Without better data and coordinated oversight, we can't accurately map the exposures and the connectivity risks.
And what about those liquidity mismatches we discussed, particularly in investment funds holding illiquid assets like private credit or high-yield bonds?
For investment funds, the report stresses the need for timely and consistent implementation of the guidance already put out by the Financial Stability Board, FSB. This specifically means things like expanding the availability and, importantly, the usability of liquidity management tools.
Like swing pricing.
Swing pricing is a prime example, yes. It adjusts a fund's net asset value, NAV, during periods of large outflows, essentially making the investors who are leaving bear the trading costs incurred by their redemptions. This discourages preemptive runs. But also, for funds investing heavily in genuinely illiquid assets, regulators should seriously consider requiring longer minimum redemption notice periods or lower redemption frequencies. This fundamentally addresses the liquidity mismatch at its source, especially important now that retail money is flowing into areas like private credit, bringing that procyclicality risk.
And finally, for the banks themselves, the ones holding the bag if NBFIs run into trouble.
For banks, it really comes down to rigorous supervision and implementing existing standards. Strict adherence to the internationally agreed-upon Basel III framework is paramount, ensuring banks have sufficient capital and liquidity buffers. And supervisors need to really sharpen their focus on monitoring banks' concentrated exposures to NBFIs. They need to assess both the solvency and the liquidity implications under severe adverse scenarios, like the ones modeled in the report, to prevent that contagion flowing directly from the non-bank sector into the core banking system. The stress test showed that's a very real danger.
Okay, so we have completed our deep dives into the IMF's October 2025 Global Financial Stability Report, Shifting Ground Beneath the Comb.
And I think we've seen pretty clearly that the current tranquility in global financial markets might just be a surface phenomenon. It seems to be masking some significant accumulating structural risks. We've covered the historically stretched valuations, highly concentrated in just a few mega-cap names. We've discussed the fiscal sustainability issues driving up term premiums and eroding the safe asset status of core bonds. And we've looked at the massive, complex, and highly interconnected non-bank financial sector, which seems poised to amplify any shock that comes along.
Yeah, and the way these vulnerabilities, the high concentration, the eroding safe asset status, the fragile bank NBFI nexus, seem to reinforce each other. That's quite sobering. It suggests that when the next correction does arrive, it might not be just a standard cyclical downturn. It could be amplified through these structural channels in ways that, well, could generate broader systemic stress much faster than policymakers might be able to react.
Which is why the GSFR urges policymakers to remain highly vigilant and respond promptly. Action today on urgent fiscal adjustment, cautious monetary policy, and enhanced NBFI oversight seems necessary to prevent these shifting grounds from ultimately leading to significant instability.
Absolutely. So let's leave our listeners with a final provocative thought to mull over as they digest all this. Given this increased interconnectedness we've discussed between highly levered NBFIs and the traditional banking system, and the reliance of both on core sovereign bonds that might be losing their ultimate safe asset premium, What single trigger do you think poses the highest risk of unraveling the current calm? Is it a geopolitical shock, a sovereign debt crisis somewhere, or perhaps the failure of a major NBFI? Something to consider.
Indeed. We certainly hope this analysis has equipped you with a bit more depth to navigate the complexities that undoubtedly lie ahead.
Thank you for diving deep with us today.